Okay, guys, it's Thursday, February the 13th, and I have a rant about the bond market. So I'm looking at this fund that I found, ETF, that is composed of 7 to 10-year U.S. Treasury bonds. It's a bond fund. So if you look back to 5 years ago, this is the 5-year chart. If you look back to 5 years ago, people were paying $122 for this ETF, and today it's worth 92. So we're going to go over here to my Word document, my notes, if this thing will work. Okay, there we are. So if you bought it originally for $122 and now it's worth 92, you've lost 27.60 per share. Okay, your remaining purchasing power would be 64.40, which means you do the math over here in percentage terms, you've lost 47% of your purchasing power in the last 5 years on this genius investment you made to loan the government money right here. So let's go over here to trading economics. And we're going to look at the US 10-year. We're going to pull up the 5-year chart. And you can see that the geniuses that made that loan to the US government back in 2020, the US 10-year was yielding as low as 5.536%. So let me put that in perspective. It's 2020, and I'm going to loan the US government $10,000 today. They're not going to pay me back for 10 years until 2030. And for the use of my money, my interest payments from the US government are going to be $536. No, no, I'm sorry, not $536, $53.60. That's what the US government is going to pay me for using my $10,000 per year. $53.60. Who in their right mind would loan $10,000 for 10 years for $50 a year in interest? I got a feeling the answer to that question is nobody. But let's just look at why, this was in August. That's when these yields bottomed. Was August of 2020. Let's look at what happened right before that. Okay, the Fed printed up literally $3 trillion and added that they just printed $3 trillion out of thin air by June. And so we get into August of that year and yields are down to 5.3%. And that's probably where this high water mark, yep, August. That's where you paid $122 for this bond ETF. So, like I say, the people that made that idiotic loan have lost 47% of their purchasing power. Okay? And that's assuming that the real rate of inflation was about 30%. Okay? So, we come in here today, and yesterday morning we got a much worse than expected inflation report from the government. So what they're telling us is that the consumer prices were expected to be increased 0.3% month over month. That goes from December to January, but we got 0.5%. In other words, for consumers, the prices of the goods and services that they buy went up by 0.5% between December and January of 2024 and 2025. So over in a 1 month. And so they're telling us that the year over year they were expecting 2.9 again. It was a miss. They got 3%. And then they also play around with these core numbers as well. Let's see what they did with core. Okay, core was expected at 3.1. They got 3.3. Month over month was supposed to be zero point 0.3. So it was a miss on every single metric that they have. And when you look at this, that chart does not tell me what Powell is telling me. Powell is telling me there's nothing to worry about with inflation. Everything's going fine. But look at that. That doesn't look like inflation is is going fine. That looks like to me it's getting worse. And so now we're going to look at the producer prices, and so yesterday the bond market made sense. The bond yields spiked. So in other words, people were selling their bonds. They didn't want to hold on to that investment any longer, and bond yields spiked. They went up about 10 basis points yesterday based on these horrific consumer price inflation numbers. Now, what we're going to look next today at the producer price inflation index, which leads the consumers because remember, prices go up first for producers and then they pass those costs on to consumers. So right now we're looking at the 1-year chart of the commodity index. It is at a 52-week high. It's also at a 5-year high. It's also at a 10-year high, and it would be at an all-time high if it wasn't for 2008 when oil got up to $140 a barrel. But commodity prices are on the rise, and as you would expect, producer price inflation is was a miss. Okay, they were expecting zero point 0.3, they got headline zero point 0.4. For the annual, they were expecting 3.2, they got a horrible miss, 3.5. So today's miss on inflation with the producers was just as ugly as almost just as it wasn't quite as bad as yesterday, but it was still horrific. And all that report this morning did was confirm all it did was confirm yesterday's report. Inflation is on the rise. And so what happens? You would expect bonds, okay, if you were going to loan your money to the government yesterday for 4.6% and then you get this report today that confirms yesterday's report, now you might be asking for 4.7%. This is a riskier bet. But what happens in the bond market? Somebody comes in buying the shit out of the US 10-year. It's down 9 basis points today. It's yielding 4.5%. So who's buying that? Now, Gregory Mannarino has insisted for years that the Fed has a secret balance sheet and they're buying it all. Well, that makes sense to me because, the stock market is just a derivative of the bond market. Look at NASDAQ. It's just as happy as it can be, up 185 points on this because bond yields are down. That's what happens. When bond yields drop, that's very stock market positive. When bond yields are spiking, that's very stock market negative. Now, this market over here, NASDAQ, doesn't know anything but to be happy with everything. The earnings don't matter anymore with this market at all, I'm convinced. I mean, 5 of the 6 Mag 7 components that have reported had disappointing guidance in the MSM headlines. 5 out of 6. We get NVIDIA on the 26th. Only Apple missed on the headline top and bottom numbers, but they did get bad. They had good guidance, so they were the only one of the 6 that have reported so far that had good guidance. The rest of them all had bad guidance in the MSM, Yahoo Finance type Reuters. They had those words, bad guidance, in the headlines. The other 5 of them, and we get Nvidia to report on February 26th, but I just don't understand this bond market at all. It's never made sense to me. Who in their right mind, when inflation is at 3.5%, the Fed chairman is telling you he's got it licked, it's under control, we don't have anything to worry about. But then you come back in here and you look at this chart, and I'm sorry guys, but this chart does not look like the Fed's got shit under control. It looks like inflation, we're going through another wave of it, and it's just starting right now, especially when you come over here and you look at the commodity index. And it would be at an all-time high if it weren't for $140 a barrel oil in 2008. It's definitely at a 10-year high. Commodity prices are producer price inputs, and so producer price inputs are going to try to absorb that cost increase as much as they can, but ultimately that's going to get passed on to consumers. So who is loaning their money today? I just can't wait to buy. It's got to be the Fed. It's either that or it's the Exchange Stabilization Fund. But what I can tell you is these markets are fake. There is no way a true market of bond buyers is coming in here saying, buy, 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 buy. I got to have U.S. Treasuries. Buy them. I can't wait to get destroyed by inflation the way we got destroyed from 2020 to 25. And I've lost 47% of my purchasing power on this stupid, what is supposed to be a safe investment. So, anyway, that's my rant for the day. We'll talk to you guys later. See you.